This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of the previous session, I left you with not only some revision and some further rereading to do, but also with an example to have a go at as well, which hopefully now you have both performed and checked out with that model answer at the back, which I'll review through with you in a moment's time. Just to remind you there, we saw a situation where in the 2021 tax year, Tina had made disposals of 3 assets. Of those 3 assets, 2 of them gave rise to gains, 1 gave rise to a loss. In terms of the type of asset we were dealing with, we got a painting in there, we got a commercial investment property and an antique vase. All of those 3 are chargeable assets. As we said, 2 gains arise and 1 loss, but in terms of the tax rates that will be applicable, it's the same. These are other assets as compared to residential property or assets that would indeed rank for business asset disposal relief or investors relief there. So on that basis, we are going to be looking at just one set of tax rates. It's either 10% if we're basic rate, and then anything above that into higher rate will be 20% CGT rate. Let's have a look at the answer, therefore, and see how we fared. In terms of the calculations of the gains and losses themselves, well, I would hope not too much difficulty there. We knew our disposal proceeds in relation to the painting. We knew our cost, and therefore it's an easy calculation of the gain. The investment commercial property. Now, I keep emphasising commercial property. Had this been residential, then the calculation of the gain itself would not have changed. It would be exactly the same. It always is. What are our disposal proceeds, and what are the allowable costs that we have incurred to set against that, and establish the gain accordingly. But if we had a gain on a residential property, then we'd have to keep that separate to any other gains on any other assets, because residential property has its own separate tax rates. More of that, though, later, because it wasn't applicable here. This is commercial, and therefore it's subject to the normal CGT rates of 10 and 20%. As we'll discover here, 20% of course, because the taxpayer, we'd already determined from a first read through the question, the taxpayer was a higher rate taxpayer. But simple calculations, again, the disposal proceeds less any selling expenses to get net proceeds, take away the cost, and you end up hopefully with a gain of £95,300 there. With the antique vase, didn't prove to be such a good investment. We end up with a capital loss of £5,000. Put it all together to establish in the 2021 tax year, we have net gains of just over £240,000. We must take away, of course, our AEA first of all. That's our £12,300 for the 2021 tax year. And then, as we have given information about it, there are some brought forward capital losses there that are dwarfed by the extent of the now net gain for the year, and on that basis are fully absorbed, giving us again a huge figure of taxable gains of some £213,000. Now, as we said, Tina's taxable income was such that we exceeded the basic rate band limit. Tina is a higher rate taxpayer for the tax year, and on that basis, all of the taxable gains will be taxed at 20%. As a higher rate taxpayer, the higher CGT rate of 20% applies. Now, what we can see in this example is because each of these assets giving rise to gains, the painting and the commercial property, because the same CGT rates are, well, here it was 20%, otherwise 10 and or 20% there would apply. It's the same rates. So we were able to do one overall calculation, adding these 2 gains together and then taking away that loss from that total of the gains. Understand that if this had been not commercial but residential, then residential property gains in the higher rate band wouldn't be taxed at 20, they'd be taxed at 28%. So on that basis, when it comes to deducting that loss, where would we have deducted it? We'd have had separate columns here for the two gains made. Our residential property separated out from any other assets. That was just the painting, the only other one that we made a gain on. And now we've got the loss on the antique vase. Well, where would you want to make that deduction? Which gain would you rather reduce? The gain on the painting or the gain on the now residential property? Well, if it was a residential property, it's 28%. As a painting, it's just 20%. So very clearly, you would be deducting the capital loss of £5,000 away from the gain suffering tax at the highest CGT rate on a residential property. If it were that would be 28% as compared to the painting, or as we see in this question and the answer to it, it's only 20%. Not an issue here because both gains were subjected to the same tax rates. But watch out for that. Had I just changed it to residential property there, then we'd need to keep that gain separate from any other, and we would allocate any losses and indeed any AEA from those particular gains on residential property. We've mentioned that with the loss, the same would hold true in relation to the AEA. Again, if you can't recall this from the previous session, go back, look at your notes, see where those deductions, those losses and the AEA, where do they go? They will reduce the gains that are to be taxed at the highest tax rate. That's residential property as compared to other assets. Again, here though, we got our taxable gains in a single calculation, all of it at 20%. Why? Because the taxpayer is a higher rate taxpayer. So should therefore be no problems on that. Let's go back to the notes therefore now. And moving on from that, we come to, well, a little bit of exam technique.
In any examination that you sit, given the nature of objective testing questions, there are always going to be some questions that you cannot deal with. We have a very big syllabus. There's a huge amount of detail. So we can't legislate, nor must we worry about dealing with every possible question. But what you must do in terms of exam technique is to ensure that if you do have the knowledge to be able to correctly answer any individual question, that you use that knowledge in the right way and secure the right answer and therefore the marks. There is nothing more infuriating, more costly in terms of your exam performance than if you forego, you give up marks that you could and you should have scored. Now, if you've done the reading that you'll see on the screen in front of you here, based on the things I've already told you so far, we see here a perfect illustration of where although students will possess the knowledge to get questions right, they will make silly mistakes and therefore miss out on those marks that they could and should have scored. This is the type of error that you have to ensure that you deal with and you do not make these mistakes in the exam. And most of this comes down to not rushing the question. Too many people do not look in detail at the requirement of the question or indeed fully understand the information provided within the question. In their haste to press buttons on the calculator, which they do very quickly, they don't always press the right buttons. Or if they do, they don't always go to the end result that is required of them. So it is critical, therefore, that you read the information in the question and analyse the precise requirements of that question very carefully. Only when you have decided that you know exactly what needs to be done and the means by which to do it, do you then proceed to start pressing those buttons on your calculators, but do not rush in. So, as you will hopefully have read since last time, we can see here that, again, when we're dealing with calculations of CGT, it is even more important than ever to ensure that you properly read and understand the information provided in the question. Now, here are the typical examples. Does the question give you the figure of taxable gains? In the exercises that we've done so far, I'll be giving you both taxable gains and taxable income. And that was then used as the basis from which you could then compute the CGT liability. Now, you know that taxable gains is after having deducted any capital losses and, of course, your AEA for the tax year. So, does the question give you the figure of taxable gains, or does the question tell you the chargeable gains and you then have to compute the taxable gains? They might give you the net gains of the year. Those net gains, gains less losses, will be before deducting any AEA. You have to deduct the AEA away from the net gains to be able to establish taxable gains. Obviously, if you have capital losses brought forward as well, then those two must at the very end be dealt with, if of course there's anything to deduct them from at that point in time. But what you may get is taxable gains, so that's the figure after AEA, or net gains, which is before any deduction of AEA. So it is also going back to Chapter 2 under your understanding and awareness of the structure of the income tax computation. Again, up until now in these exercises, we've been looking at a figure of taxable income of the taxpayer. Bottom line, taxable income on that first part of the income tax computation before moving into the tax liability calculation. Now that bit of course is not required here in CGT, but we do need the taxable income figure. Now you may be lucky and they may, as I have up until now anyway, just given that figure to you. That taxable income figure is therefore after having deducted any personal allowance of the taxpayer for the tax year. So does it give you the taxable income of the taxpayer for the tax year, or are you simply provided with income figures that require you then to deduct the personal allowance of the taxpayer to compute the taxable income? So net gains, not the same as taxable gains. Net income, not the same as taxable income. We will need, if a CGT liability is required of you to compute, we will need to know taxable gains, taxable income. Do they give you those figures as a starting point, or do they give you net income and net gains from which you respectively deduct your personal allowance and your AEA? Make sure you interpret that information correctly. I've received on the Ask the Tutor questions forum many questions over the years where someone saying, why have we deducted the AEA, or why haven't we deducted the AEA? Why have we deducted the personal allowance, or why haven't we deducted the personal allowance? Simply based on students not having read the information provided within the question. So make sure you get that right. In addition, read carefully, as we've said, the requirement of the question to ensure that you're actually answering the question's the correct requirement. So, for example, does it actually ask you to calculate the CGT liability? We'd probably expect it would do, of the taxpayer, or simply to compute the taxable gains of the taxpayer. They may give you individual assets with market values and or sale proceeds there, your allowable costs, and you've simply got to work out what the net gains of the year might be, and then the taxable gains after deducting any AEA. They don't necessarily always ask you to compute the CGT liability, so make sure you're answering the correct requirement. Does the requirement ask you to compute the taxable gains after AEA and losses brought forward, or simply the chargeable gains before AEA and losses brought forward? Again, what do they want? Do they want taxable gains? Do they just want net chargeable gains? Do they want CGT liability? Make sure you correctly interpret the requirement. So, as we've said, you do not rush into those calculations. You don't waste time either. It's an exam. There is a strict time allocation, of course, to be adhered to. But you make sure before you start to jot things down, calculations down, press buttons on your calculator, make sure that you know what needs to be done. You've correctly interpreted, well, at least as best you can.
So based on what you've just been told, therefore, let's have a go at some examples here. Now then, what is required? Looking at example 2, as it will be for each of these, calculating the capital gains tax liability for our tax year 2021. Read the information carefully. Again, what we have seen is that in an objective testing question for a couple of marks, we may be presented with the taxable gains, the taxable income, or we may not. So what have they told us here? Matthew has a trading profit of £20,000 to be assessed in our 2021 tax year, and sold an antique vase, giving rise to a capital gain of £18,300. So we don't have the taxable income, we don't have the taxable gains. We have a figure of income. Now that's the only figure of income that we're told of for the 2021 tax year, the trading income assessment. You've got to work out, of course, the taxable income. I wonder how you do that. I do hope you know. And of course with the capital gain. A single disposal, capital gain £18,300. Well, is that the taxable gain? No! Another certain deduction needs to be made. And so it is also with example 3, where there's Katie with a trading profit of £41,000 as our 2021 assessment. Sold a commercial investment property. Again, that's the important word, not investment. Commercial property is what you're interested in here, rather than residential. And again, we've told what the gain will be, just over £30,000. So in each of those two examples that I want you to have a go at now, we are given income and gains figures. You've got to calculate the taxable income and the taxable gain, and then put that information together to work out the CGT liability. Shouldn't be a problem for you, so over to you now. So pause at this particular point, have a little go through those two examples. I'll come back to example 4 later, but have a go at example 2 and example 3, and then I'll meet you again the other side of that, and we'll just quickly talk through the answers to it. Okay, let's see how we got on with these examples, therefore, and hopefully no problems. We needed to establish the taxable gain, and of course we simply needed to deduct our AEA from the capital gain given. In another circumstance, you may have had to compute that chargeable gain for yourself. More likely than not, of course, is that there will be more than one gain, and probably there will be a loss in there also. And again, you must compute that taxable gain. So you know there's a £6,000 taxable gain, but to be able to work out the capital gains tax, you need to know what tax rate will be applicable. And for that, we need the income tax computation. Just the one source of income, trading income. Take away, of course, this time the personal allowance, to give us taxable income. As that is the only source of income, £7,500 of taxable income leaves a very substantial remaining basic rate band of £30,000. More than sufficient to cover that £6,000 of taxable gain, all of which therefore falls in the basic rate. And as this is, again, one of those other assets that we are referring to, it isn't residential property. It isn't, we don't yet know what assets would rank the business asset disposal relief or investors relief. So it's just other assets, it's the 10% rate. Therefore, £600 worth of CGT liability, and any gains that are taxable in relation to the 2021 tax year, we have until the following 31st of January, so that would be 22, in which to pay the tax. On to example 3. Once again, we needed to calculate the gain, simply enough. We need to calculate the taxable gain there. And for that, we needed to deduct the AEA. We then need the income tax computation figure, the taxable income therefrom, to be able to work out, is there any remaining basic rate band? Well, yes, there is. £28,500 of taxable income, taken away there from the £37,500 limit, means we've still got £9,000 remaining. So the taxable gain of £18,000 9,000 of that, the remaining basic rate band, is taxed at 10%, and the remaining 9,000 moves up into higher rate to be taxed at 20%. Add through those two figures, and that would appear to be some £2,700, and again, if needed, the due date the following 31st of January there. Going back now to the main body of the notes, and we've got example 4. Now, it's only a little bit more interesting. It's not difficult still, not for the likes of you anyway. And what we've got this time is still a requirement to compute our capital gains tax for the 2021 tax year. Again, we're given a single figure of income from which we'll need to deduct the personal allowance to get the taxable income. We're told what the gain is on this asset. It's a painting, so it's an other asset therefore. A capital gain of £26,300, so a more significant number this time. But he made a gift aid payment of £2,400 in that year. Made a gift aid payment. £2,400 is the actual amount paid. What's the relevance of that? The relevance, which you should recall from your Chapter 2 income tax knowledge, is that we have an extension of our basic rate band by not the amount of gift aid paid, but by the gross amount of that gift aid paid. It would also be true had I said personal pension contributions here, paid of £2,400. We must gross those up times 100 over 80, grossing up for the basic rate of income tax of 20%. And that then would extend your basic rate band. Now that would be relevant, of course, if the amount of taxable gain that you have computed takes you above that revised basic rate band limit. And that therefore means you then go into higher rate. Of course, if your gains would take you above 37,500, it's still imperative that you've worked out that extension of the basic rate band to know that you do not start taxing your gains at the higher rate when you've gone to 37,500. You need to extend that basic rate band limit, see how much of it is available, and that will be at 10%, and then the excess, only the excess, will be at 20%. So I'd like you please now to have a go at that one. So again, pause, I'm sure just for a moment or two, while you do the calculations upon it. Check it out with the answer, and I'll join you in that answer in but a moment's time. Okay, looking at that answer now to example 4, you had to work out the taxable gain, simply the deduction of the AEA from the given figure of gain. To be able, however, to tax that taxable gain, we needed to know how much, if any, basic rate band remained from the income tax computation. The income tax computation had just one figure of income, a trading income figure of £45,000. Take away the personal allowance to give you taxable income of £32,500. So how much basic rate band remains? Well, it's not 37,500 minus 32,500 because we need to extend that basic rate band of 37.5 by the gross amount of that gift aid, or had it been the case, personal pension contribution paid during that tax year. So that increases it from 37,500 to 40,500, meaning therefore that we've in fact got 8,000 remaining of our basic rate band. It wasn't needed, it wasn't necessary within the income tax computation, but it is now necessary to do that calculation in relation to CGT. So 8,000 remaining, so there's the CGT calculation, 8,000 at 10%, meaning that there's still 6,000 of the 14,000 taxable gain to be taxed, and that therefore will be at the higher rate of 20%. Work your figure out, and if it was necessary, the due date, as ever, the 31st of January, following the end of our tax year. Back to the notes and to example 5. Once again, we want the CGT liability for the taxpayer for 2021. So what have we got this time? Well, it all looks the same. We've got a trading profit assessment, this time just £21,500 in 2021. No other taxable income. So that's the one figure of income. We know, therefore, we'll need to take away our personal allowance to get our taxable income and use that figure to establish the remaining basic rate band, so we can then determine the CGT rates applicable. She sold 2 assets during the tax year. This time, now then, what's the important word there in terms of residential investment property? What's the important word there in residential investment property, I hear you think? And it is, of course, the fact that residential property is going to be taxed at higher tax rates. So we have to keep that gain separate to any chargeable gain. And we've got here that residential investment property with a gain of £30,300, and then an other asset, it was in fact a diamond ring, yielding a chargeable gain of £12,000. Now, of course, we're given figures of gains. We need to establish taxable gains. To do that, we need to deduct our AEA from, well, there's 2 gains there. They've got to be kept separate. You need to make the decision from which gain would I firstly use and deduct my AEA. Something, of course, we should know by now. Once you've done it, you'll have 2 figures of taxable gains, and then you can proceed to tax at the relevant tax rates. Again, there depending on how much basic rate band remains, if any. So I want you to have a go at that, try and solve those particular problems now for yourself, and then of course we'll discuss them again when you've completed that exercise. Okay, well, probably the most interesting example indeed that we've had to deal with in this section. Because we've got residential property, it is subject to those higher tax rates. Anything remaining in the remaining basic rate band is 18% instead of 10%, and in the higher rate band is 28% instead of 20% there. So we kept separate the gain on the property from the gain on the ring. The only thing we had to do is to work taxable gains, and for that we needed to deduct the AEA. Well, where are we going to deduct it? Now that, I hope, you chose the residential property, because it is that asset that bears CGT at the highest rates. So let's save tax at the highest rates by deducting any AEA, or indeed, had there been any losses brought forward, any available deductions, any current year losses indeed, any deductions that could be made, be it through losses or the use of AEA. Where are you going to go with it? You're going to go against the gain suffering tax at the highest rate. That is always residential property. So we apply the AEA to it, bringing down the gain on the property to a taxable gain of 18 and leaving the taxable gain on the ring at £12,000. So now we need to tax it. To be able to tax those gains, we need to know information about our income tax computation and our level of taxable income. Well, the taxable income here of Gaynor, she had income of 21.5 minus the personal allowance, giving us £9,000, therefore, of taxable income. We have a basic rate band limit, which is not extended here. No information about any payments that would cause that extension of the basic rate band. No gift aid payments, no personal pension contributions paid. So the basic rate band limit stays at 37.5, minus the figure of the income tax computation of taxable income of 9, leaving us therefore with 28,500 remaining basic rate band. You have seen here that we have taxable gains equal to £30,000. So we're going to move through from basic to just a little bit of the gains being taxed at the higher rate. Now, here I have shown, as you can see, that the first gain that we have then proceeded to tax using up the first part of the basic rate band was indeed the gain on the property. Now, as it will transpire, if you've read through and seen this note here and this calculation here, it actually doesn't matter. But routinely, I would probably do this anyway. That whatever is the taxable gain to be taxed at the highest tax rate, I would probably deal with it first. But it would not matter in terms of the amount of CGT that you then compute, whether you firstly tax the property, as has been done here, or whether you firstly tax the ring, which is what has been done here. Right, let's see what we've got here, therefore. So the gain on the property, we had, where are we there? With a gain on the property, taxable was 18,000. The basic rate band remaining is 28,500, more than enough, therefore, to encompass all of the taxable gain. Its residential property gain, still within the remaining basic rate band, so it's 18% rather than 28%. What does that leave us with in terms of that remaining basic rate band? Well, we had taxable income of 9,000. We've now proceeded to tax a further 18,000. If you get your calculators out, that should have left you with 10,500 of the 37,500 basic rate band available. So of your £12,000 taxable gain on the ring, the first 10.5 uses up the remainder of the basic rate band and therefore is 10%. The remaining balance of some £1,500 here, that's pushed into higher rate and therefore is taxed at 20%. Get your tax calculations, add them together, get your total figure. Get your two tax figures, add them together, and there is your total CGT liability. Now, I would imagine that that particular order of taxing those taxable gains is what you chose to do. I don't know even whether you'd have thought about, does it matter? You may have done and thought, well, okay, so this taxable gain, this is the one at the highest of the two rates as compared to the diamond ring, so I'll tax it first. But as it would turn out, it actually wouldn't matter. It says here, once you've correctly deducted any capital losses and the AEA from those gains suffering CGT at the highest rate, which we made the point we must do, and we've computed the resulting taxable gains, it will not then matter whether, as above, you firstly tax the gain on the residential property or whether you firstly tax the gain on the diamond ring. And the reason why it doesn't matter is because the differentials between the two rates are both 10%. You move from 10 to 20, or you move from 18 to 28. So whichever order, you are still going to have the same amount of gains there to be taxed. And as that difference between the rates is exactly the same, it doesn't matter which one gets the higher 10%. It's either that one gets an extra 10% or that one gets an extra 10%. It doesn't make any difference, therefore. So, again, that can be proven. No one's going to ask you to do that. All you need to be aware of here is it doesn't matter, but you probably would do the first answer that I've given to you. If we did it the other way, there was the diamond ring. It was 12,000, comfortably within the basic rate band, so taxed at 10%. We then had £16,500 of basic rate band remaining, and this is now devoted to the residential property. It's in the basic rate band, so that's 18%, and the self-same 1,500 as we had before, pushed up into higher rate, goes up from 18 by a difference of 10% up to 28%. Do your calculations and see what you get. 4,590. 4,590. It doesn't make any difference, so it isn't anything to worry about. But again, if I'm doing an objective testing question, the examiner doesn't see any workings anyway, so it doesn't matter. If I was doing it in a section, well, unlikely to be in a section C question, to be honest. But if it were, then I'd show it probably using that particular technique then. But it doesn't matter, so don't worry about it, therefore.